Okay, let's get started. If anyone logs in a couple of minutes, although this is my introduction, which will not be the end of the world. So welcome to another in our enterprise webinar series, Selling Your Business, What Are Your Options? My name is Esther Carter, very pleased to be hosting this morning. You can look forward to lots more topic discussions. Details are available on our website, and invitations obviously will be sent out in due course. But if anyone has any particular burning topic that they'd like to hear us talk about, then please do email in your suggestions. Now, I'm sure most of you are familiar with who we are because I can see lots of regular names of the delegate list. We tend to have some sort of regular attenders to these webinars. But for those of you who don't know us so well, Moore Kingston Smith are a top 15 UK audit, tax and advisory firm working with businesses across all different sectors, lots of entrepreneurial businesses across different sectors, as well as not-for-profit and private clients. We're also part of More Global, which is an international network with presence in 100 different countries, or over 100 different countries, should I say. And our corporate finance department has completed hundreds of transactions across all different sectors of clients that we work with, and help businesses to grow, acquire, sell, and to realise their maximum value. So this morning we're going to be talking about selling your business, and given the uncertainty, sort of the real sort of economic uncertainty that we're facing at the moment, and the political turbulence that more recently we're facing, more business owners are wondering, is now really the right time to sell my business? The volatility of the market shows no signs of letting up really, but that by no means means that you should be holding back from selling your business. In reality, there really is no particular perfect time to sell. And the right time will very much depend on your own personal circumstances and how the business is doing, etc. It's very personal to you. So today we're going to talk you through the various different options that are available to you, who's buying, what deal structures look like, the reasons that we're seeing our clients selling right now, alternative strategies to selling that are gaining some traction, and also what are the key value drivers that can help you maximize your consideration. So today I'm delighted to introduce Nick Thompson, who's one of our corporate finance partners, and Nick Blundell, who is our corporate and transaction tax partner, or one of, I should say, our corporate and transaction tax partners. Please do ask questions as we go. I'm going to do some light sharing and be asking some questions. It's much more interesting and much more valuable to you if you ask your own questions as well. Please do ask those in the Q&A function. Much easier to keep track of them there, and I will try and insert them as we go. And the webinar is being recorded, so please do share that with your peers or anyone who couldn't make it today, or anyone who you generally think might be interested. So let's kick off then. So, I mean, given, I've already mentioned that, the economic uncertainty that we're facing, is now a good time to sell your business, or should owners be sort of putting the brakes on any exit planning?
The $1 million question there, Esther.
Mm-hmm.
And it's difficult. We don't have crystal balls. There's never really the perfect time. As you said, you're never going to get it spot on. But it's about making educated decisions and planning regardless. So I guess to talk about the current M&A activity in market. So March 2020, COVID happened. The world stopped, deals sort of stopped for 3 or 4 months. Since then, deal activity has been really high, valuations have been high. So 2021 was the highest sort of volume of deals ever in a year. That was sort of 60,000 globally, and valuations were as high as they've ever been. Since then, so sort of first half of 2022, volumes have decreased slightly, but they're still higher than they'd ever been in a 6-month period other than last year. And the valuations have dipped a little bit, but again, they're still the second highest they've been in the last 10 or 15 years. So, deals are happening at the moment, even though that might seem strange given, the economic uncertainty and challenges that we face. It's about whether it will continue, isn't it? And if you look at sort of the economic and social headwinds facing us, there's quite a few. They will affect the economy. They will affect the number of deals that happen. Inflation, people problems, talent, the Great Resignation, supply chain, world wars, all of that stuff. It's to be to be found out what that impact will be. That said, if you're thinking of selling your business, one could argue, on the other hand, it might be more challenging in 5 years or a few years' time. So maybe now is the best time to do it. I think, as you said, Esther, there's other factors than the economy and deal valuations and volumes. It's certainly for owner managers, it's an incredibly personal decision. Probably the biggest sort of moment of their life, other than maybe getting married and having kids, buying a house, that kind of thing. And so, planning and assessing the options really is the key.
Absolutely. And who's buying at the moment? Who's sort of most prolific out there?
Well, sort of in the UK last year, about sort of 30% of deals were private equity buyers. I think globally it was a little bit higher than that. So private equity is still sitting on lots of dry powder, and they have been very active since, well, prior to COVID, actually, in the year before, but that's still going strong. And then there's a lot of global consolidators out there, big trade buyers. That there has been a lot of sort of owner managed businesses where the shareholders wanted to sell after COVID. Pretty rough year. If you were thinking of exiting at some point in the next 5 to 10 years, and then went through COVID, quite a lot of stress. They'd be worrying at night, that kind of thing, looking after their people, trying to navigate the challenges. I think so. A few people had enough, quite frankly. Also, a few people thought it'd be quite nice to have private equity put an arm around me and support me, so I'm not doing this alone. And so I think there was also a lot of people wanting to sell, as well as businesses or investors wanting to buy, which was a perfect storm.
And Nick, what about the tax climate? What's that like for deals now, and is that likely to change in the near future, particularly if there's a change in government?
Yeah, it's something that's been going on for a while now. I think I've been working on transactions for the last couple of years now, where often people have been racing to try and get them through just before a budget, on the expectation that capital gains rates are going to be going up, and they still haven't gone up after all this time. So I don't know whether a change of prime minister is going to do that. My suspicion is that capital gains rates will probably stay the same, because the argument in the Tory party doesn't seem to be about Rishi Sunak wanting to put rates up and the others wanting them to take them down. It's more about Rishi Sunak not putting them up anymore at the moment, but tax cuts coming as a delay. I don't think that the whoever we might get as the next prime minister from September is going to give rise to an increase in rates. But you never know what's around the corner. There's been capital gains rates have been very competitive against income tax rates for a very long time now, so we are in a sort of period of turbulence around that. But I can't see that the rates are going to go up. But that's just my opinion. Lots of people think that they will go up because there's been such divergence and competitive capital gains rates for such a long time now.
Yeah, because we all thought they were going to go up to sort of 30, maybe even 40%,
yeah,
with a flurry of activity.
When you put sort of a capital gains standard rate of 20% against a sort of top rate of income tax of 45%, it looks like a big difference. And people have talked about realignment or closer rates for a long time now, but it still hasn't happened. No,
well, hopefully it won't as well. So Nick, Nick T. So what are business owners' options really in terms of who they can sell to? When you mentioned sort of private equity getting a bit more, a lot more activity, a lot more money to spend. I mean, typically, what are your sort of options for third party sale, and what sort of deal structures are we seeing? And do the deal structures vary depending on who you're selling to?
Yeah, absolutely. They vary. I think there's a few questions in there. I'll try and pick them off. So if you're looking at selling to a third party, really you do have two options. There's trade buyers, which can be split into some subsectors, and private equity. Both deal structures for either are pretty different, to be honest. So if we look at trade sales first, this is maybe listed groups, overseas buyers, consolidators, competitors. Usually we'd expect them to be buying a majority stake in a business. And in terms of how that's structured, again, there's plenty of options. I think really at the moment, and this probably applies to trade and PE, the challenge is working out what the normalized revenue or profitability should have been over the last few years, because in some sectors they've been negatively impacted, in others it's been positive, and so there's going to be changes coming up, and we talk about EBITDA, which is earnings before interest, tax, depreciation, and COVID.
Yeah,
and it's really difficult, because if you just think of the overheads of a business that has furloughed staff, and they've received government grants, but what revenue did they miss out on in that time if they've been working? You're estimating, you're guessing, aren't you? So working that out is the key. Trade buyers, they use earnouts, deferred consideration. We've actually seen sort of a few consolidators out there sort of shy away from earnouts recently. Earnouts are great for buyers because they get to they get to protect themselves against a drop in profitability and pay less on day one. For sellers, they're not great because you don't get everything from day one and you've got to work, but you get the chance to increase your consideration. But they inevitably leads to some kind of gaming and lack of integration, where the company that's been acquired, the shareholders are thinking about their earnout rather than the greater good of the combined group. So we've seen some examples where sort of deferred payments have been based on other metrics, so retention of key clients over time period, or winning X amount of value of new clients, that sort of thing. So that's been quite an interesting change over the last couple of years. Private equity, I split this into a couple of streams. So you've either got my majority acquisitions or minority, so that's sort of more growth capital, where they'll be acquiring a minority stake, say 20-30%, and putting money into the business to help grow it, support it, bring their expertise, versus a majority sale to private equity, where it could be 100% or over 50% with some sort of sweet equity for management, that kind of thing, to grow the company and be incentivized.
And with private equity, I mean, how long can one expect them to want to maintain their investment before they want to realise?
So I think people typically say 4 to 5 years, but actually there's plenty of PE houses out there that hold assets for the absolute long term. It's not just a flipping game necessarily, like the reputation might be, but I think 4 to 5 years, generally would be the sort of timeline.
Now, when I speak to a lot of my clients, and just caveat, most of my clients are in the sort of media marketing services sectors, there is this sort of view of private equity that they're a bit sort of the big bad wolf. They're going to come along and asset strip and do lots of nasty things to you, and life will never be the same. But I don't think that is quite the reality anymore, is it, Nick?
No, I mean, it's interesting, because I think sort of several years ago that was changing, the view was changing, and it almost surprises me that it's still, there's some people out there that think that. I think it's just a hangover from years gone by. Yeah, don't get me wrong, there will be some occasions where that's the case, but really private equity are there, they're trying to increase the revenues, profitability and value of the business so that they can sell it, and it's quite a negative outlook to think they just do that by cutting costs. Yes. And really, if you're an acquirer, when they come to exit the business, if you can see that they've just stripped out a load of overheads and their margins are really high and it's not sustainable, it's pretty clear when you review the information, do due diligence, and it will get adjusted on price. Anyway.
And what about how much sort of interference people get from private equity? I mean, can you expect them to want to have a place on the board and be involved in the day-to-day decision making? Yeah,
I mean, they'll always have a place on the board. Again, it really varies. Some PE houses pride themselves on, we literally will leave you alone unless there's a problem. others will get more involved. And actually having both options is great, because different sellers or businesses want different things. Some want an arm around, some they want to grow internationally. They've never grown a company overseas, so they need some support. And the more they can get is brilliant. So it's not just about the money sometimes.
Yeah, no. I mean, certainly, a number of my clients who've been bought by private equity, they're having a really exciting time, because what private equity is doing is facilitating that growth and making more funds available to go and make really good, interesting strategic acquisitions. So it's actually become a really exciting growth journey.
Yeah, I mean, it's really interesting, in your sector, sort of media, marketing services, the levels of private equity involvement these days. I think 10 years ago, I don't really remember PE being very interested in the sector at all.
No.
Now I'm pretty sure it's half of the deals last year.
Has been, 50% of the deals last year were private equity. It's crazy.
Yeah, 5 years ago, if you said to me that was going to happen, I wouldn't have believed you. Absolutely not.
And then moving to the other Nick. So from a tax point of view, then, what levels of CGT can a seller expect to pay if you're selling to a trade buyer or private equity?
Yeah, so there's a bit to that question, actually, depending on what you're actually selling. But just at a very high level, the sort of standard rate, as I mentioned earlier, of capital gains tax, which is what a seller might generally expect to pay, is 20%. We still do have entrepreneurs relief. It's not called that anymore. It's called business asset disposal relief. I think people still refer to it as entrepreneurs relief. Now that gives you a reduced rate of 10%, but that's only for the first million. So that might be very useful for some people in some deals, or it might be a relatively small part of a much bigger deal. And just to mention as well, you can't use that £1 million on multiple deals to get a 10% rate of capital gains tax. That's just a lifetime allowance per individual. So once you've used up your sort of million for entrepreneurs relief to get 10% rate, that's it. You're done for good. But outside of entrepreneurs relief, it's a 20% rate of capital gains tax. So it does depend on what you're actually selling. So if you're a sole trader, that might not apply to many people on this call, but just to cover it off. So if you don't have a company, you're just trading as yourself, and you sell that. That's capital gains tax, the rates I just talked about. But if you own a company, then it depends what type of deal you're in. So if it's a share deal and you're selling the shares in your company to a buyer, then again, that's you individually selling your shares to the buyer who's going to buy the company, lock, stock and barrel, and that's a capital disposal, which is capital gains tax, the 20% and the 10% entrepreneurs relief that I mentioned. Now some buyers, they don't want to buy the company because it might have a load of history that they're not interested in, that they don't want it. It might come with too much baggage, too many skeletons in the closet that might pop out from years gone by. And actually a buyer might prefer to buy just the trade and assets of the company. So not the company itself, just the assets that are within the company. And a buyer might force that on you from a commercial point of view, because that's the only way they may be prepared to buy. Now, in those circumstances, that is not the individual selling the shares in their company. That is the company selling its assets. So rather than the capital gains rates that I talked about earlier, the 20% and the 10% entrepreneurs relief, that sale by the company of its assets is subject to regular corporation tax rates, which at the moment are 19%, but we really don't know whether those are going to go up, down, or sideways. Really, that seems to be a big debate. One of the big debates of the Tory party leadership at the moment. At the moment, rates are due to go up. Corporation tax rates are due to go up to 25% from March next year. Other people, I don't know whether they might have already left the contest, but there are various leadership hopefuls who want to reduce the rate to 15%. So I think all we know is that the corporation tax rates are probably not going to be 19% going forward, but they are going to change, but we don't know whether they're going to go up or down. But I suppose the important point is that a lot of this depends on what you're actually selling. If it's a share deal, then the rates might be different to if it's an asset deal, and that partly depends on the commercials. So it's really important to understand what you're selling and who's doing the actual selling.
Absolutely. And we talked about, when Nick talked about, various different deal structures, and sometimes you get everything up front, and sometimes you get part of it up front and the rest of it as a deferred element, perhaps contingent on future profits. So if we have a deal that's got that earn out element, when do we pay the tax on that portion of the consideration?
Yeah, so it's a really good question. So that the answer often in tax is it depends. If it's sort of a straight deferral, so I don't know, it's just that you're going to get 50% of the proceeds in 3 years' time, but that's already fixed. It's not dependent on anything. That is treated as all received now, if you like. So although you might not receive some of your proceeds for some months or years down the line, you would get taxed on it all now, because it's sort of fixed and it's known, and you know what's coming, and that's how the rules work. So there's important cash flow considerations on that front to know that you're going to be taxed on the full amount now, but you might not get all the proceeds that you want now. So that's important to be aware of. There are other circumstances, and it depends how you structure the deal, where it might be dependent on future profits, and you just don't know what those amounts are. And in those circumstances, you generally in a position where you get taxed on some of that now, but some of it might be in the future. Now can be a bit of a gamble, because you might say, oh well, I'll wait to effectively be taxed on it in the future, because I'll get taxed when I actually receive the money. But you're also taking a gamble on whether capital gains rates might go up by the time that you actually receive that money. So there is thought to how to structure the deal in terms of an earn out, and what you can negotiate in terms of what you're prepared to do now when you want to be taxed on it.
And do all the shareholders have to go for the same treatment, or can it sort of vary from shareholder to shareholder?
Not necessarily. So there might be multiple shareholders. I don't know, say there's 5 different shareholders, and they may have different agreements on what their earn out is, whether they're getting an earn out, how it's treated for each individual shareholder. So it's down to the individual position of each particular shareholder, rather than the same rules, same position applying to all, because they might have a different deal for each individual.
Great, thanks. Now, I've had an audience question, the first one, please do pile them in. And it's a brilliant segue into the next question that I was going to ask. So somebody has said, how best for an owner manager to sell in order to get back at least some of the investment that I've put in over the years, yet protect my staff at the same time? I do worry about how they will be treated. How about selling the business to the staff themselves? So my next question was going to be, okay, so we could sell to a trade buyer, but what alternative strategies are there to that, Nick?
Okay.
Feels like that was a planted question.
It does feel like it was a planted question. Yes, it wasn't.
Although I don't think it was. Yeah, I mean, outside of some of the normal routes that people generally talk about, trade by third party buyers and the sort of standard forms of exit, there is a form of exit that you can do to the employees, that it's really worthwhile people considering, because there are some tax elements to that that's important. So there is a concept of selling your shares to something called an employee ownership trust, which essentially puts the business in the hands of the trust, which is there for the benefit of the employees. And I suppose there's a couple of key advantages to that. One, as the questioner has alluded to, if you feel you've got an absolutely fantastic team who've been a major part of building your business, but you want to exit either in full or in part from the business, putting it in the hands of those employees that have been a really important part of the team is a really good way for people to exit the business and leave it in capable hands. I suppose the other thing, the way that the government has sought to encourage this, I suppose, to try and follow the sort of John Lewis model, is that sales of businesses to employee ownership trusts are capital gains tax free. So all that stuff we're talking about rates, what rate of tax will you pay? Will they go up? Will they go down? That all becomes irrelevant, because with the right structuring of a sale to an EOT, that it would be capital gains tax free. There are a number of conditions to it, not least that you actually have to give up a controlling interest, and in real and practical terms, you have to give away control to the EOT. So you don't need to fully exit, but you do need to dispose of 51% of your business directly to the employee ownership trust, and they have to take control of the business as part of one of the key conditions of it. So you can't sort of give part of it away, a minority stake, and take that as capital gains tax free. It doesn't need to be a full. The business doesn't need to be entrusted into the EOT.
And I think, my experience of having done quite a few EOTs, actually, that tends to be the bit that people struggle with the most is, I do actually have to give up control. And that's kind of the quid pro quo, really, if you're getting the 0% tax, isn't it?
Yeah, exactly. The transaction doesn't work from a capital gains tax point of view unless control is given over to the EOT in sort of all aspects. So you can retain an element of the business, sort of up to the 49% if you like, but that key element of control needs to go over to the EOT. So if you're in a position where that just doesn't work for you, where you only want somebody to come in as a minority investor, an EOT won't work.
No. And Nick T, have we seen many EOTs then go through to a trade sale yet? Because that is an option after you've done an EOT, isn't it?
As far as I'm aware, I know the first one got sold a couple of months ago. I haven't seen any since then, if I'm honest.
No, because there doesn't be a window to get the tax relief, doesn't there? So you wouldn't want to be selling it too quickly after having done it.
No, agreed, I think.
Yeah. I mean, it's interesting. We'll see how. I mean, the form of, if you like, government. This is government-backed scheme, if you like. It's introduced by the government, so it's not aggressive tax planning, but it is essentially to encourage that form of employee ownership and employee buy-in to businesses. Where particularly where owners want the employees to carry it on because they feel like they've got a great team.
Yeah. And Nick T, what other strategies are people employing where a trade sale isn't really an option?
So there's a sort of the classic management buyout.
Yeah.
Where if you've got an aspirational management team below you who would like to take on the business from you as an owner. It's obviously clearly reliant on them being aspirational. It's quite scary for a management team, to be honest. So generally the way that they're structured, this isn't necessarily the way that owners get the most money when they sell their company, but it's a way that often owners feel like, fair play, the management have delivered, they've been working here for 15, 20 years. I'd like to pass it on to them. There's a bit of an emotional thing going on there. So unless you're paying your management exceptionally well, they're unlikely to have the money to buy your shares outright on day one. So what tends to happen is there'll be some kind of loan. So it's often bank debt, could be a term loan, or based on your trade debtors, invoice discounting or factoring. Combined with, generally management will have to have some skin in the game. A lender would want to see, they always, it's quite vague, they describe it as a significant amount of money to the individual being invested, so often a year's salary, that kind of thing. The bank needs to see them put something in, and then the difference is normally made up by a combination of deferred consideration or vendor loan notes. So that's when a shareholder, it's basically an IOU that will have terms like any other loan. We saw a lot of MBOs that were funded by vendor loan notes after COVID, where, as I mentioned earlier, some shareholders kind of had enough, but management team couldn't get the loans or didn't have the money, so they just said pay me off out of profits. And essentially, the management team in that instance, they're getting the business out of profits without putting a hand in the pocket, which sounds great, but you see a lot of management teams get nervous as the actual deal, get closer to the deals, because they haven't run a business before. It's very different, as business owners will be able to testify. Getting your paycheck each month versus making sure everyone gets paid each month, and some people don't like the risk. That's why entrepreneurs are a particular type of person.
Yeah, absolutely. And presumably this debt comes with personal guarantees from the management team as well, which adds to the nervousness.
It can do. I think most lenders, I mean, we'd never be advising people to, put their house on the line. Your personal life and work life should be separated, otherwise things can go really wrong. But that's not to say that sometimes, we have seen management secure debt on their personal assets. It's just not really desirable, clearly.
And Nick, are there any specific tax considerations for MBOs?
Tax considerations for MBOs are mainly on the people mainly on the MBO side rather than on the seller's side. If you like, for the seller, it's very much the same level of the same sorts of tax considerations that we've been talking about. Okay,
well, a question come in, and to whoever asked it, it isn't a stupid question, as they're suggesting it might be. How does a sale to a private equity house create funds for business expansion and growth if they are essentially paying the business owners out for their shares? Is there usually a simultaneous agreement to pump in more cash to the business for expansion?
So in a growth capital deal, you wouldn't expect the shareholders to be taking any money off the table generally. So they're not getting paid. They're not extracting consideration. The money in exchange for shares is going into the business at that point to be used.
Yeah. Okay.
There are occasions with minority stake PE deals where the owner might say, well, I'd just like to pay off my mortgage and get the school fees, get a bit of money off the table just to get comfortable, to mean that they can go forward and not be worrying about that sort of stuff. And so there are different ways of doing it, but generally growth capital is just money for growth.
Somebody's asked, if you want to reward your key team upon a sale who don't currently have any shares, what should you put in place, and when should you consider putting these in place? I think that the short answer is think about it ahead of a sale, and obviously that's what Nick and his team do, is help people on that journey towards preparing for sale, to make absolutely sure that there are, if it's relevant, some equity incentives for employees, and that they have been there for the relevant amount of time to get all the tax reliefs and stuff. It becomes very difficult, doesn't it, Nick, if you try and put equity in place whilst you're in the midst of doing a deal, because it becomes very difficult to argue low values, and you get a lot of tax leakage that you wouldn't otherwise have got.
Yeah, it's much better to put equity incentives, whether it's sort of EMI schemes or other types of equity incentives in at that sort of stage. Like you say, it's much better when it's much earlier on, and you can agree a much lower value for the business as it is at the time, and that ultimately gives the people leaving the business from a management point of view a much better answer for them personally. So doing it just before a deal it doesn't necessarily work out for the best, but and also similarly, you don't need to it doesn't necessarily need to be through equity incentives. There are other ways if you don't want to do it through equity, through bonus schemes or whatever that are very much tied to the performance of the business, but certainly early planning and implementation of those, well ahead of a process of a sale is definitely to be advised.
And Nick T, often, you would expect buyers to put in their own sort of long-term incentive plans post-deal as well, wouldn't you?
Yeah, certainly. For the same reasons, you want them to be incentivized to grow the business. They'll be done slightly differently between trade and private equity. There's, with the private equity deal, there's often a sort of a pot called sort of sweet equity that's put aside for management and future management that join, which isn't a feature of trade deals. then, yeah, as Nick says, there's a range of different share option schemes or bonuses, really.
Another question then before we move on to my last question is, how does one signal the company is open to being bought?
It's a good question, that, because it's quite a sensitive subject, isn't it? Because, you know, you don't want to spook customers or clients, you don't want to spook staff, but it's really important to, you know, have your brand out there and be known by the buyers. You know, I think if the shareholders are approaching 60 years old, you know, it might be pretty obvious to their staff that they're going to sell at some point or retire. It's, you know, it's outside of that situation, it'd be more challenging. As part of a preparation for sale, we suggest meeting, speaking with the buyers in your sector, going for lunches. You don't have to say you're selling tomorrow, but, you know, you're thinking of your options, and, you know, interested to know what their views are, the evaluations in the market and that sort of stuff. It's yeah, gently flirting with them to start, I think. Rather
than a big billboard outside your
exactly.
shop window saying we are for sale. I mean, I think we've got other webinars that we've done, which probably got recorded on our website, which do talk a little bit more about the whole sort of process of selling your business and goes much more into the detail of that. And no doubt we'll be repeating that webinar at some point as well. So moving on. So, I mean, Nick, most business owners are only going to ever sell a business once in their life, aren't they? Like you say, it's a lifetime opportunity. So it's absolutely vital that they get it right, and vital that they get the maximum that they could possibly get for their business. And so how, I mean, there are various different ways that businesses are valued, but typically what sort of valuation mechanisms are we seeing?
As you say, there's lots and lots of different ways to look at it, but generally I'd sort of split into multiples of revenue, or multiples of sort of normalized pre-tax profits, would be one method. And then, you know, asset heavy industries will be based, their valuations will take into account, you know, some of those larger assets or properties as well, of course. You know, sort of a people-based business, I'd expect it to be a multiple of revenue, a multiple of profits, maybe sort of more of a SaaS recurring revenue type business. That would be a multiple of revenue rather than profit.
There are lots of different things that kind of feed into the valuation of a business and what makes a business valuable. But sort of when you're working with buyers, what are the real sort of key attributes that you can see that they're looking for, and what sort of helps to pump up that multiple of profits?
Yeah, so it's an interesting one. Everyone focuses on increasing their turnover or their profits. Actually, increasing your multiple can have a far bigger impact on the end valuation of your business. So, you know, these multiples, you know, if you're applying it to profit, broadly, what they reflect is if you have a multiple of 5 on your profits, that the buyer considers in 5 years' time they'll have got their money back, and then, you know, assuming no growth, and then, you know, and then they're in, you know, in the black. Each sector will have a different range of multiples, and they're applicable to it. And where you sit on that range is based on, you know, quite a few factors that need to be focused on in the build up to sale, and most of them will actually increase your profitability as well. But they're what makes a business attractive and means that you can command a higher valuation, which is what everyone's there to do. So, you know, just thinking of a few, it might be your client mix. You know, are you dependent on one client, or have you got, you know, lots? You know, income security. You know, is it recurring revenue or project based? Obviously, recurring revenue and retainers are stickier and more desirable. How much reliance there is on the shareholders that are going to leave the business, and the sort of quality of the management team as well. And sort of, you know, your value proposition in the market, how you're perceived, how strong it is, your competition. And then I think the list sort of goes on a little bit, but another key one at the moment is sort of ESG is becoming a hot topic and getting considered, which I don't think that was on the agenda a few years ago. And then lastly, something as simple as your management information, your financial records. Are they produced quickly, correctly? Can you deliver them during due diligence? And are they correct and useful? Really does make a big difference. Your tax affairs as well, the amount of deals that fall over because of things like that, or cash, values left on the table because of poor records.
Yeah, I mean, certainly, good, strong management information is it's really important for the day-to-day running of a business anyhow, but it's also really important because the amount of information you're going to have to provide throughout the course of due diligence on the business is quite a lot, isn't it, Nick? And if you haven't already got your ducks in a row, you could come a cropper through that process.
Yeah, and I think people forget what is great for running your business anyway, of course, and all of those things work. Everyone should be stepping back from the day-to-day trading and thinking about those points and focusing on improving them. But people forget when they're selling that you're going to get asked for 3 or 4 years of financial information as well, and it all needs to be good. So there's no point getting in a bookkeeper or someone to sort it out a year before you're exiting and change accounting systems and stuff like that, because that's going to compound the issue probably.
I think it really is all about getting your ducks in a row a number of years before you're planning to sell, and making sure that you're engaging with the likes of Nick from our corporate finance department and Nick from a tax point of view to find out what are the things that are going to help you achieve your goals, to help you achieve the consideration you want, to help you sell to the right buyer that's going to be strategically right for you, that is going to be kind to your employees and help you achieve your dreams and aspirations. And that can't all be done, a month or two before you think you want to sell. That has to be I'd say a couple of years out from selling in an ideal world. Now, in an ideal world doesn't always happen, and that doesn't mean you can't then go on to sell. But in an ideal world, this would be a very carefully considered, planned process to give you time to fix all the sorts of things that Nick talked about that are the key value drivers. So I'm conscious that we badged this till 10:45 and it's 10:44. I've got time for one question I think we can squeeze in. What sort of, and apologies, Nick, if you've already said it and I missed it, but what are the typical multiples that you are seeing right now? Again, Nick Thompson again, in terms of deal values. I mean, there's a bit of a range, isn't there? It does depend.
Yeah, that's
always depends.
A challenging question to answer because it's completely dependent on the sector. So if whoever asks the question wants to drop me an email later, I can tell them more about the sector. But I'd say that if we're looking at revenue multiples of profit, 5 to 10 is the range across different sectors, but 10 might be an IT managed service business that's doing a few million quid with loads of recurring revenue, and 4 or 5 might be sort of a lower margin distribution business. It really does vary from sector to sector.
Yes, I mean, if anyone is seriously considering selling their business, please do contact us, and Nick and his team will do deep dive consultations with you. And one thing that they will do is go through and do a traffic light exercise and look at all the key value drivers and look at whether you're red, amber or green and which you need to improve on, and look at what sort of multiples you might be able to attract for your business. So I'm going to wrap it up. Thank you very much all for coming. There will be a feedback survey sent out. It's short, it's very quick, but it's really useful. Please do fill it out. This is the last one for our summer break, so we will be back in September with lots more interesting topics. Like I said, any burning topics you want to hear about, please email suggestions in. There might be a couple of questions that still are unanswered. We will pick those up and we will email specific answers to you if we haven't already done so. Thank you very much for joining, everybody, and enjoy the rest of your day. Thank you.